Hi guys, Azid. Today I'm going to talk about interest rates and what the trajectory that I think, or well, from reading in between the lines, what's going to happen in 2024 onwards. So we're now in April 24. The bank base rate is still at 5.25. Lending rates for investors like us is around 6.5–7%, which is astronomically expensive when you think 3 years ago, before Liz Truss and Kwasi Kwarteng and that disastrous mini budget that they did, crushed the economy basically and pushed all of our lending for as a country massively high. It used to be 0.1, which was untenable because, you know, although it's been like that for 20 years, since 2008 to 2021, really since COVID, it's jumped from 0.1 bank base rate to 5.25 because people around the world start thinking, hang on a minute, we're not going to lend to this country. It is the government looks shaky. And that's what pushed the prices up on interest rate borrowing. We are still via 5.25 bank base rate, which means that as investors, we're still paying, on average, I'm refinancing around 6–6.5% at the moment, fixed for 5 years. So where do we see it happening? Well, quite frankly, one of the reasons why the interest was so high, or is so high, is because inflation rate was up to 10–12%. 18 months ago, 12 months ago. That means that cost of things were rising at 10–12% per year, which is ridiculously high. Just to give you context, on average, the Bank of England mandate, and that's their job, is to keep inflation, the rate of things rising, at around 2% per annum. And it was at 6 or 7 times more over the last 2 years. Why was it happening? There was loads of reasons. Ukraine war, energy prices, there were so many other external factors to the country as well that was happening, that was pushing this inflation rate up. Food prices was rising. So things that everybody needs. Food, energy prices really skyrocketed, and that pushed everything up. So because of this inflation, the Bank of England has only got one tool for them to actually lower inflation, and that is to push the cost of borrowing, because the more we borrow, the more we spend, the more we're chasing a fewer goods, the prices rise. And it's a virtuous circle. If you don't stop people from spending, almost halt the economy, you can't bring down inflation. And it's been over like almost 2 years now that the interest rate's been high, and inflation has now thankfully gone from 12% to around 3% in March, April. So it is back down to where we need to be, which is the target at 2%. It's around 3–3.5% at the moment. And even the Fed last month in March, and the Bank of England are also now intimating that they're not going to wait for the 2% to drop, to stop, because there is a drag. So they're waiting. They're now starting to say, and I read this morning, that they are intimating that the first rate of cuts will be somewhere around June, July, August, somewhere in that kind of quarter. And why? I mean, today there's a massive surge on the stock market, which is the 23rd of April 2024. Stocks are rising because they are expecting the Bank of England to start cutting interest rate. Why does that happen? Well, because the idea that, you know, the prices, interest rate will start to drop. That means people will have less to pay towards interest. They'll have bigger and higher disposable income. When they do that, they will go to the shops and start spending their money on TV, on a phone, on cinemas, on restaurants. And that's why the businesses their share price started to rise today, because the expectation that interest rate will drop. And that's a good thing for also, of course, property investors as well, because my expectation is going to be that over the next 3 to 5 years, we should get to a point where our borrowing rate is around 5%. Right now it's at 7%. So that means if our borrowing rate at 5%, bank base rate will be around 4-ish%, which is what, when you look at, take out the last 20 years, before that, the last 50 years before that, the average lending has always been around 4 to 5% as a borrowing rate for investors. So I hope that helps. And if you're thinking about, do I come in now? Do I buy now? Do I wait until August or September, whatever it is? The answer is, I always give this: it depends on what you're buying and the discount you're getting. I am about to exchange on a property on Monday, the 29th of April. And I'm already on the way in buying it at a 75 to 80,000 pound worth of discount. That's even after I've spent 20. I'll spend 20 to actually do the house up to a certain standard. So if I'm doing that, actually it's irrelevant for me whether it's, well, not irrelevant, but even at 7%, I'll still buy it because I'm getting a discount, which is then I will use that discount as part of my deposit, and the passive income will be the rent minus the interest only payment that I will be paying. Even at 7%, the rent's still high enough for me to then take a £300-400 profit per month. So the idea is, it depends what you're buying, but also if you're thinking about remortgaging at the moment, lots of people ask me, well, what do I do? Do I wait? Do I hold? Do I remortgage now because the banks are giving me a better rate now? My answer is, personally, I'm waiting for some of these deals to drop, because I thought June, July, now they're saying August. So it will be around that sort of time. Bearing in mind we've got an election coming, I think that will be also an incentive, although the Bank of England are independent, a nudge, I guess, to make the people feel happy if the interest rate starts to drop. And I think that helps the government as well. So my name is Azid. I've been investing for the last 25 years. If you're watching this and you haven't seen a lot of my other content, I'd urge you to go back and have a look at some of the things that I've actually posted about property investment and property development. I've been doing this for 25 years. We've got hundreds of tenants, property managers. We've got a good structure now as an organized company. We also do, and if you see behind me now, property coaching, property training. More specifically, I don't do the single buy-to-let entry level. I'm coaching experienced landlords to expand their portfolio. So that's what I kind of specialize in. So if you've got money sitting in the bank, you've got assets that are basically maybe you can take money out to build your property portfolio. Book in with us, come and do my one-to-one with me. It's a 12-month program, and I'll and get you to buy more properties, take your money back out at each time that you refinance, so you recycle all your money out and you use that money again to buy the next one. So you can check out our website, www.quidditygroup.co.uk, or send me a DM and let's connect. Thanks for watching.